Hey everyone, welcome back to Corporate Decoder, the place where we decode the sometimes confusing world of corporate filings. Today we're diving into a Form 8K from Access Newswire Incorporated, filed in early March of 2025. And believe me, this one has more twists and turns than a mountain road, especially if you're a fan of stock transfer services, which is probably nobody. Okay, so the big news is that Access Newswire has entered into an agreement to sell off a chunk of its business, specifically its compliance business, to Equiniti Trust Company. Think of it like selling off one of your company's departments. This happened at the end of February, and it involves something called an asset purchase agreement. So what exactly did Access Newswire sell? Well, it's a collection of assets related to providing services like disclosure software for financial reporting, stock transfer services, meaning helping companies keep track of who owns their stock, annual meeting services, everything from printing documents to handling shareholder communications, and even virtual annual meeting services. The exception is that they retain the intellectual property related to the virtual annual meeting services. They are getting rid of a group of services that deals with regulatory compliance, with some smaller exceptions. It's important to understand where this compliance business fits into Access Newswire's overall revenue. Previously, the money generated from these services was reported under their compliance revenue stream in their filings with the SEC, the government agency that watches over companies. What's interesting is they get to keep the whistleblower hotline and the SEDAR service, so it is not a complete cut. Now for the juicy part, the price. Equiniti is paying $12.5 million in cash for these assets. However, there's a bit of a twist. They got $12 million at closing, and $500,000 is being held back like an escrow for a year. This holdback acts as insurance for the buyer, Equiniti, in case there are any issues or claims that come up after the deal closes. Think of it as a warranty fund. The agreement also includes the usual promises and guarantees from both sides, as well as commitments to do certain things. And of course, there's a section about indemnification, which basically means each party agrees to protect the other from losses if they breach the agreement. But wait, there's more. This asset sale has a direct impact on Access Newswire's debt. They also entered into an agreement called the Third Modification to Credit Agreement with Pinnacle Bank. They had previously borrowed money from Pinnacle under an agreement from the previous year, and now they have to change this agreement. Remember that $12 million they got at closing? Well, they're using it to pay down their debt to Pinnacle Bank. Specifically, they're reducing the principal balance of their term loan from $15.3 million to $3.3 million. That's a huge chunk of debt wiped out. Because of this big payment, the monthly payments to Pinnacle will also go down significantly, from over $300,000 to around $72,000. Plus, Pinnacle is releasing its claim on the assets that were sold to Equiniti. So to recap, Access Newswire sold its compliance business for $12.5 million. They used the cash to pay down debt, which significantly reduces their monthly loan payments. To make sure everyone knew what was going on, the company also issued a press release announcing the sale. The filing also includes some pro forma financial statements. Pro forma means as if. These statements show what the company's finances would have looked like if the sale had happened earlier. There's a balance sheet and an income statement presented on this as-if basis. Here, we can see their unaudited pro forma condensed consolidated statement of operations for the 9 months ended September of 2024. This is very relevant to the discussion since it is the as-if basis we discussed earlier. One thing to note is that, according to the financial statements, if the sale happened earlier, the revenue for the company for the first 9 months of 2024 would have been $31.3 million. Operating income would have been approximately $2.9 million. And finally, the net income would have been approximately $1.8 million. This gives investors a good idea of what to expect for the company after the sale is complete. So what's the big picture here? Access Newswire is slimming down, focusing on a narrower set of services. They're using the proceeds from the sale to reduce their debt, which strengthens their financial position. From what I see, this looks like a pretty solid move. Management saw an opportunity to get rid of a piece of their business that wasn't essential and use the cash to improve their balance sheet. The risk here is that they might lose some revenue in the short term, but the long-term benefits of reduced debt could outweigh that. Their debt was significantly reduced and gives them a better financial footing. While this will create less revenue in the future, the boost that the company gets from having so much less debt is very valuable to the business and probably a positive. Overall, I'd say Access Newswire is heading in a more focused and financially stable direction. The company can now focus on what it does best with a much healthier balance sheet. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate deep dives.